Hi guys, we are going to discuss about swaps, what is swaps and how swaps work. So let's see here. If I talk about swaps it means it's exchange of anything. Exchange of anything means you can exchange anything. For example, let's say risk. You can exchange risk. You can exchange commodities. You can exchange interest payment. You can exchange currencies and even revenue of the business and equity portfolio as well. So it's a very simple. When we say swaps, it means it's an exchange of anything. You can exchange anything. Now, see, we have a ISDA. ISDA basically International Swaps and Derivative Association provides framework for a swaps contracts. But if you see, same swaps, we had that as a barter system in past. Barter system in past, right? Barter system. And you know it, barter system it means. Barter it means exchange of goods. So means, let's say you have a rice and I have a wheat. So you can exchange your rice with me, right? With my wheat. So I'll also exchange that my wheat with your rice. So this is how we had a barter system in past. So same barter system which has been integrated, or I would say which has been upgraded, that same model they have replicated with swaps. So now means that your barter system you can relate with the swaps, and that's what we exchange cash flows, we exchange risk, we exchange currencies and everything with your counterparts who are willing to take a risk or who is ready to take that your risk and even cash flows and everything. So let's see this. I have an example for interest revenue swaps, or I would say revenue swaps, or total revenue swaps, basically TRS. So we are going to discuss this example. So I have it, so you can note it down everything. All right, let's say this is your total revenue swaps, and you have, let's say, two counterparts. Counterpart it means let's say buyer and seller. So you have two counterparts, A and B, both are ready to sign swaps with each other. See, A is holding portfolio. A is holding portfolio of three different stocks. One is Wipro, TCS and Infosys. So total portfolio value is, which is around 3 lakhs, right? So now, see, this person B is looking for exposure. Exposure it means total revenue from this particular portfolio. So revenue includes both profit and loss. So it means this person B want profit and loss from the portfolio, let's say A's portfolio. Whatever value would be, that's fine. This guy is ready. But against the revenue, the B is ready to pay interest rate of 10% on notional value of the portfolio. And here notional value of the portfolio is 3 lakhs. So now it means with this 3 lakhs portfolio notional value, this total revenue swaps contract, it will be initiated. So now let's assume it, this contract has been initiated. So I'll take you ahead to see. Let's say at the time of initiation, the contract value or portfolio value was 3 lakhs. Alright, so here you don't need to exchange anything at the moment, means at the time of initiation of the contract. Let's say contract started from 1st of January and closed out. Close out it means, see, always we sign swaps for a 10 years, maybe 5 years, 2 years, even though you would see weekly, daily and even monthly as well. So that's a different story. But if you see at the time of initiation, you don't need to exchange anything. Alright, so this is the close value of that portfolio at the time of signing the contract. And let's say as per the contract, the portfolio value was 3 lakhs on 1st of January. But what about 31st of March? Maybe on 31st of March, let's assume it, the current portfolio value is 3,50,000. So it means there is appreciation in the portfolio value of 50,000. So this gain. So basically, A is holding this portfolio, right? A is holding this portfolio. Now, if you see in this contract, so this person B will pay 7,500 interest payment to A. Why? Because see, A was looking for, this person is looking for fixed interest payment. and that's what at quarter end this person B will pay 7,500 interest payment. So basically 10% was the rate. 10% divided by 4. So it would be around 2.5% for per quarter. So that 2.5% which you can calculate on 3 lakhs, which is notional value, because we always calculate interest payment on notional value, and we have calculated it. You can try it. Calculation would be 3 lakhs into 2.5 divided by 100. Just do it, and you can you would see around 7,500 interest payment. So here basically this B will pay 7,500 to A, and A will pay gain, whatever gain you would see. This guy will pay gain to B. But eventually, if you pay entire gain to A and B, or even if you ask that person to pay entire interest payment to you, so it's a kind of duplication of transactions. So instead that, why don't you offset them, or why don't you settle that particular transaction with net payoff? If you see, the net payoff is 50,000 basically your gain, and 7,500 basically which is your interest payment. So 50,000 minus 7,500, you would see net cash flow of 42,500. So this 42,000 it will receive to basically B. Why? Because B took that risk. B will receive this amount. Alright, and A will pay. The reason is, see, this person B has purchased the total revenue from the contract. So this is how your swaps works. Alright, what if, sir, if there is a loss? So in case of loss, if you see in this example, we have covered loss. Let's say at the quarter end 2, the value of portfolio was 3,50,000. So it means this particular this contract got reset, and once the contract got reset, so it means new amount, whatever new amount would be, that you can consider as a new notional amount. And if you see, if you compare this notional amount with the current market value of quarter end, let's say 2, right, once the quarter end of 2 will end, so let's say that value reached at 3,40,000. 3,40,000. So basically here if you see difference of 10,000. So basically it's a loss, you would see, right, when you compare with the first quarter. So loss of 10,000. So in this case, see, A will not pay anything to B then. Why? Because actually the portfolio is in loss of 10,000, and this guy, as I said, if you go back and check it, I said, so it means B purchase revenue. Revenue includes profit and loss. If there is any loss in the portfolio, so this B will bear entire loss, and as well as interest payment also it will be paid out by B investor to A. This is how your swaps works. And in this case, if you see total interest payment, again which is 10% for per annum, so around 2.5% interest payment, you will have to charge it on 3,50,000. Charge it would be around 8,750. So interest payment leg is for this, and total loss which is around 10,000. So total 18,750 rupees it will receive to A. So it means in this case B will pay to A. Now see the pattern, guys. If you see in loss, if you see any loss, so it means basically in this particular scenario, or second scenario I would say, B has paid total loss plus interest payment to A. This is how your cash flows it will be generated. And now I'll quickly brief about how in terms of Recon how it looks like. You would see two legs. It means all in a swaps we calculate legs. One leg generated 50,000 revenue, and second leg which was fixed 2.5% interest payment for per quarter, so which is around 7,500. and the difference of this would be your coupon payment or basically revenue, because in a banking or in actual process you would see on swaps we receive coupon, but coupon is nothing but it's an interest payment, so that we receive, we calculate and process it in the books of account, and same coupon that counterparties booked as a revenue or expense in their different books, depends on the buyer and sellers. So this is how your swaps works. All right, this matching or recon example, it was from the it was as per the first example that we have discussed. So it means first example, which was the case of profit. In case of loss, just you tried to brief about fixed leg and variable leg and also coupon payment, and you can also try to post your answer in comment section. All right, so this is how your total revenue swaps work. So in short, I'll just summarize it. Total revenue swaps, it means if you have any business or if you have any investment portfolio, so that portfolio you can transfer, means exposure of that portfolio you can transfer to someone against the fixed amount. And anyways, if you are holding that portfolio, it means still you will be the owner of that particular portfolio, but eventually you will have to send that entire profit of your portfolio to the counterpart who is going to pay fixed interest payment to you. So now your question would be, so what is the benefit when you transfer all your benefits? See, you can protect your investment from the market certainties, and apart from that you can generate the fixed return on your portfolio if you don't want to take any kind of risk. So this is how you can see this particular hedge, not hedge, but I would say cash flow, or anyways your swaps in your fund accounting business. But anyways, now if I talk about swaps, I'll give you a hint. Maybe in your academics you would have learned about cash flow. Hedge fund is the example, sorry, the swaps is the example of cash flow. All right, and even this comes under your hedging as well. Hedging, it means to mitigate the risk. So this is how you would see swaps in your in your maybe process, or maybe in your academics, or maybe I would say in your interview process as well. So all right, I'm done with this swaps. If you have any questions or concerns, you can post your opinion in comment section, and if you like this video, please share this content with others as well. So we'll see you next session on different topics. Meanwhile, you can check the link in description. I have designed curative course on private equity. Quickly check it. That course I'm offering in only 600. It's a recorded course. You can grab that. 40,000 worth of rupees course I'm giving you just in 600, 500 or 600 something. Just quickly do it. Thank you very much for watching this. We'll see you next session.